Good evening, everyone. Welcome to the channel. Today I am going to talk about Westchinacement interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. Westchinacement Limited offers a diverse range of businesses and services, including manufacturing and selling cement and cement products, financial leasing, mine exploitation, and sales, real estate development and operation, production, and wholesale sales of gypsum board, transportation, business, green commodity concrete production, and sales, precast components, design, production and construction, prefabricated building, research and development, design, production and sales. These services cater to various sectors such as infrastructure projects, highways, railways, bridges, hydroelectric power stations, water conservancy and transfer projects, housing and social infrastructure. The stock price of Westchinacement has skyrocketed by over 207.91% in the past year due to several positive news and corporate developments. Key factors contributing to this surge include analyst revisions, strong financial results, strategic business transactions, and expansion and acquisitions. In September 2025, Jefferies adjusted its price target for Westchinacement to HK$4 from HK$2, maintaining a buy rating on the stock. The company's interim results released in August 2025 showed a 9.9% beat in revenue forecasts, with a half-year gross profit of RMB 1,627 million and a 93% jump in own profit. The company also provided earnings guidance forecasting up to a 100% boost in its own profit, which was later achieved. Additionally, Westchinacement's full-year 2024 profit rose by 49%, with an anticipated 35% minus 45% profit increase. The sale of businesses and assets to Westchinacement in June 2025 led to a 6% gain in shares, while the acquisition of a cement plant in Congo in January 2025 further boosted investor confidence. These positive developments have collectively contributed to Westchinacement's remarkable stock price surge over the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth drivers: strong demand from infrastructure projects and housing construction in various regions, increased sales volumes due to capacity expansion and improved production efficiency, rising average selling prices, ASPs, in key markets, particularly China, growing presence in emerging markets such as Sub-Saharan Africa and Central Asia. Revenue decline drivers: weak construction market in China due to low infrastructure and real estate demand growth, low capacity utilization rates in certain regions, leading to reduced sales volumes, conflict and transportation issues in the Great Lakes region affecting clinker supply and sales. Net income and profit margins: a shift in favor of growth. The financial summary reveals a significant increase in net income, with a notable rise of 93.4% from RMB 386.9 million to RMB 748.3 million. This growth trend is consistent across different periods, with increases of 30% from RMB 2.38 billion to RMB 3.07 billion and 67.2% from RMB 973.2 million to RMB 1,627 million. Profit margins have also seen a positive shift, particularly in gross profit margin, which has increased by 3.7 percentage points from 26.3% to 30%. This improvement is attributed to higher average selling prices, ASPs, and lower unit costs. However, the EBITDA margin has experienced a slight decline of 0.6 percentage points from 34.7% to 34.1%. The overall trend suggests that the company's financial performance has improved significantly, driven by increased net income and enhanced profit margins. The company is generating positive operating cash flow, as evident from its net inflow of cash from operating activities. In 2024, the company recorded RMB 1,356,481 in net cash from operating activities, while in 2025, this figure increased to RMB 602,102. This indicates a consistent trend of generating positive cash flow from operations, demonstrating the company's ability to manage its finances effectively and generate sufficient funds to support its growth. The company's debt level and interest expenses have undergone notable changes. Notably, net debt has risen by 9.6% from RMB 9,017.9 million in 2024 to RMB 9,883.6 million in 2025. This increase is accompanied by a slight decrease in interest-bearing debt from 87.4% to 80.8%. However, current liabilities have seen an uptick of 2.1%, while non-current liabilities have decreased by 5.9%. In terms of interest expenses, the company has paid RMB 240,325 in 2025, a rise from RMB 234,381 in 2024. These changes suggest that the company's financial situation is evolving, with increased debt levels and higher interest payments. The company's financial performance varied across different regions. The People's Republic of China, PRC, and overseas markets were the standout performers, generating significant revenue and profit. In contrast, some African countries such as the Democratic Republic of Congo and others struggled, performing poorly compared to the previous year. Ethiopia and Mozambique in Africa, however, showed improvement in 2025. Management is optimistic about the company's future prospects, highlighting two key strategies for growth. Firstly, they plan to expand into new overseas markets through strategic acquisitions and disposals. Secondly, they aim to increase cement production capacity outside of China by 4.8 million tons with the completion of their DRC acquisition in 2025. These initiatives demonstrate a commitment to driving growth and increasing market presence globally. Acquisitions and divestitures overview. The company has made significant investments through acquisitions to expand its operations. Key acquisitions include the Dugongo cement plant in Mozambique, 60% stake, Great Lakes cement plant in the DRC, 100% owned, and grinding mills in Rwanda and western Tanzania, both 100% owned. Additionally, the company acquired a subsidiary for RMB 66.3 million and invested in Palmation to acquire 100% equity interest. On the other hand, the company has also divested certain assets to optimize its portfolio. Notable divestitures include the disposal of a subsidiary for RMB 381,000 and the sale of property, plant, and equipment with carrying amounts of RMB 43,606,000. The company has a history of paying dividends to its shareholders. In fact, it declared a final dividend of HK 3.7 cents per ordinary share for the year ended December 31, 2024. Additionally, in the 6 months ending June 30, 2025, the company paid out approximately RMB 185,348,000 in total dividend. However, there is no relevant information provided regarding share buybacks. Concerns about inventory buildup and supply chain disruption exist. The financial summary highlights two key concerns: inventory buildup and supply chain disruption. Firstly, an oversupply of products has been identified due to the addition of new capacity from both the group and Anhui Conch Cement Company Limited Group. This surplus could lead to difficulties in managing inventory levels. Furthermore, related party transactions on page 61 may indicate potential risks within the supply chain. Although no specific information is provided, this suggests that there could be vulnerabilities in the company's supply chain management. These concerns underscore the need for careful monitoring and mitigation strategies to prevent disruptions and optimize inventory levels. That concludes the financial summary for Westchinacement. Feel free to comment below, and I will be happy to answer them when possible.